Hi, everybody. Welcome to Out on a Ledger. We put together this presentation today because we were just talking about it. You don't know what you don't know until it becomes a problem. And what we've seen in the banking industry going through COVID and other things is that small businesses aren't necessarily prepared. They're not tracking maybe the right types of financials in order to make it so that they can tell, where their profits and losses are coming from, where the cash flow is coming from, and then if they need it, be able to apply for a PPP loan, small business loans, and other things because they just don't have the background. So today we're talking about the types of things that you should be keeping track of to make sure that your business is on track. And so with that, I will introduce Jen Supro, who can talk to you about Foundry and what she is doing here for Chelsea Groton.
Hi everyone, thank you for coming. So I'm Jen Supro. I'm with the Cash Management Department here at Chelsea Groton. We have established a banker in residence program here at Foundry, and basically what that is to provide services to the members of Foundry and the local communities to give them education and resources, not necessarily just the banking, but subject matter experts, to be that person that can help them with any financial needs they have or direct them into the direction so that they can grow their business. And it could be a startup, it could be somebody who's interested in growing a business, or it could be a large company who's well established. So providing that education is important, and events like this to help those businesses is what we're here to do. So with that, I'm going to introduce Rich.
Great, thank you. I'm Rich Balistrassi. I'm a commercial lender with Chelsea Groton Bank. And I think a few of the things that I really wanted to talk about today in particular is really looking at the last year and a half. There are a lot of lessons through COVID that we kind of learned through the way. So whether you're just starting out a business or looking to improve what you do currently, we found that there's a number of things that COVID really kind of put a magnifier on certain things that were always the best business practice, but in the last year and a half just proved that much more important. So the first one, it really comes down to financial statements and data. First and foremost, when sort of the sky was falling last March and everybody was in a little bit of a free fall, it really became essential to know the ins and outs of your business, where the profit margins were, where you were being impacted. So for a business owner, it became crucial to really understand if you're facing supply chain issues, if your margins are under pressure based off of whether or not you can operate or what products and services you can offer. That kind of data really needs to be at the forefront of what you're looking at for your business, because that's what's going to allow you to pivot and understand, okay, if this is the challenge that you're facing right now, how can you best pivot your business and your business model to figure out what's your next step, how are you going to move forward and get through, because, as we've all seen, COVID has kind of taken its ups and downs through the last year and a half, and I know we'd all be happy to be done with the masks and back to normal, but unfortunately, it's still that risk is still there. So again, understanding those core metrics is absolutely essential in being able to manage that process going forward. And another big factor is, as we saw with PPP, economic injury disaster loans, and a variety of other different types of government support programs, data reporting, financial reporting became crucial to qualifying the eligibility for those programs. So again, if that were to happen again and there were some type of aid program available, you want to be able to respond quickly, generate the reports that you need to be able to effectively pivot and take advantage of those programs, because that assistance is, again, another key component to figuring out the path forward. And a few of those, and I know we're going to cover a little bit more later on, but having access to your employee reports, understanding your P&Ls, making sure your taxes are all current, those are all crucial elements to that package. And again, having those prepared and ready so that, in the event that a program is launched, you're not stuck trying to backpedal to backfill that information at a time where you really need to react quickly and get those applications in. And the third part is figuring out, just from a high level financial perspective, what's important for you as a business, understanding your position today and where you're gonna be, potentially 6 months from now, start forecasting out, if you make certain decisions today, how that's gonna translate in your financial statements. And the two key metrics that I think are crucial in a time like that are really understanding your balance sheet well and understanding your cash flow. Those are two crucial elements. And, first from a balance sheet perspective, some of the companies that we saw that were able to pivot effectively in the last year and a half were well capitalized. They had a nice kind of rainy day fund that they were able to use to help them pivot and adapt. But understanding what that capital structure looks like for you and your business is really that's day one. If you're looking at it and you see that on your balance sheet you're carrying a certain number of receivables, for example, and now you all of a sudden start seeing your customers are a little stressed cash flow wise, and they start reaching out and saying, look, I usually pay you in 30 days. I can't pay you for 45 days now. Understanding what that impact is going to have on your balance sheet is a crucial element to that whole planning process. And then I'd say another key component of that, like I said, is really looking at your cash flow, looking at that overall cash flow cycle. So, if you're a manufacturer, for example, understanding where the bumps and hurdles can be through your cash cycle process. If you need to, because of supply chain issues, start putting out more cash from an inventory standpoint because your supply chain is facing large back orders, you can't get the materials you need to, or maybe you can get the materials you need, but you need to pivot to a more expensive supplier. Understanding how that's going to impact that part of the cash flow cycle, like I mentioned before, your receivables, and conversely, how that kind of flows all the way through so that at the end of the day, you've got enough cash in the bank to be able to keep your payroll on, cover your utilities, your overhead, and all of those things at the end of the day. And sort of at the base of all of that is really where, the financial statements are the crucial element of that, and understanding that data that's going to be crucial to all of your decisions going forward, they all come from those financial statements. So starting out with a solid set of data that's current and relevant is really going to be at the forefront of that. So today we're fortunate to have Carla here with us to talk about a lot of those different financial statements and things that you're going to need to navigate that. So thank you.
Hi, my name is Carla Demers, and I'm the owner of Demers Accounting Services. Also, I'm going to be launching a new business called Diversified, which is exactly what we're doing here, getting the business owners how to operate their businesses that they're unfamiliar with, the financial side, and learning how to properly do it by learning how to do your own bookkeeping and understanding your financial statements, building cash flows, and also building budgets. So today, a lot of you folks out there are very familiar with your businesses as far as what you're doing. You know it inside out, upside down, and you can do it with your eyes closed most of the time, but you're not very knowledgeable on the financial side. A lot of you get scared, you say accounting, and everybody goes, you get accounting. It really isn't anything to be afraid of. If you're taught it, you'll be able to do it. And it's easier than you think it is, and maybe I think it's easier because I've done it all my life, but I'm here to simplify it for you. So as Rich said, a lot of businesses unfortunately missed out on getting what I call free money because your books weren't in order. And if your books weren't in order, then really you don't understand your business completely. There's a part of it that you're missing. So you've got to keep your books up to date. If you don't have books, you've got to get them started. There are many different ways to keep track of your books, as easy as an Excel spreadsheet, which I don't really recommend because if it's not something you're going to do, then you're not going to keep up with it. There's a lot of software programs out there, QuickBooks, Xero, Zoho Books, FreshBooks. There are a lot of them out there, and you need to find which works for you. The most popular one obviously is QuickBooks. I know that they're tending to get a little bit pricey, so I've been working with Xero, which I like a lot. But it depends on what kind of business you're in as to what type of software you purchase. So I recommend that immediately is to get your books squared away and get working on that side of it. For those of you who don't know, the QuickBooks and most of the accounting programs now import the bank statements and import your credit cards. So there's not a lot of data entry you have to do. You just have to know how to expense it and where it goes. And that's what I say, bookkeeping really isn't as hard as you think it is, not so much anymore, it's become quite easy. So, when we talk about financial statements, when you're talking to your accountant, typically that means balance sheet, profit and loss statement, and a cash flow statement. The cash flow statement is not what we're talking about today. It looks a lot different, and quite honestly, I find people don't even use the cash flow statement part of their financial information. The cash flow statement, you definitely need to know. So what we're going to show you today are tools to help you manage the side of the business that you're not really looking at. And again, it's not that complicated. Even the smallest businesses could use the cash flow and the budget. So let's keep going. So cash flow projections and budgets, the whys, the what's, and the hows. Let's try to make it easy for you. The whys. All right, to start off, 80% of small business owners feel stressed because of their company's cash flow. Probably everybody right here can relate to that. So more than 3 in 5 small businesses, 62% polled for the global survey, experienced a cash flow issue at some point during their company's history. So it's not uncommon. Many of these small business owners were not prepared for those challenges, and nearly half of small business owners who experienced cash flow issues say the problems were a surprise. So if you have a cash flow and it's something that's always changing and you've got to keep up with it, it won't be a surprise for you. 57% of small business owners contribute personal funds twice a year or more. So if you're putting money into the business, obviously you're not taking money out of the business, or maybe you're taking it out, you have to put it back in. The reason why you're in business, obviously, is to have income. So despite struggles, small business owners feel confident in their financial management skills. Most global small business owners say their cash flow is under control. They say it's under control, but is it really under control? 89% of small business owners say they know the amount of money their company has in monthly receivables. That's one side. 92 feel they know how much money is coming into their business every month, and then 93% of small business owners know how much money their company spends on a monthly business expense. You have to know all of the sides. If you know how much money that you're spending, you certainly need to know and be comfortable on how much money is coming into the business. And that's why you need the cash flow. Why should you make a cash flow forecast? Well, use your cash flow forecast to predict surpluses and shortages in your company's finances. If a large tax bill unexpectedly hits your cash flow, you could have a difficult time maintaining inventory and paying supplies. I think that happens often to small business owners, is that they're not anticipating something, so their cash flow is affected. So if that bill were to come in, you would adjust your cash flow so that that bump in the road isn't going to affect everything down the line. You certainly don't want to have a hard time paying your suppliers, because then, of course, you may not get the materials that you need. That's all right. I got it. Thank you. So then we go to the what's. Why, or what is a cash flow projection? Here's the mystery. A glimpse into your business financial future, creating a cash flow projection. So a cash flow forecasting is a process of obtaining an estimate or forecast. Again, only you know this. Someone else wouldn't know this as well as you do in your own business. Of the company's future financial position. The cash flow forecast is typically based on anticipated payments and receivables. So the cash flow starts with money that's in the bank, X. Well, let's say it's $1,000. So you know you get $1,000 in there. And then you've got to look at your bills coming in. If you're keeping track of your bookkeeping, you know in your software program that you have $500 worth of bills that you have to pay by the end of the month. And then you look at your sales, whether you have receivables or your restaurant, you can typically know how much money is coming in. So let's say that's $300, you've got 1,000 already, you're spending 500, you're bringing in 3, so that brings us down to $800 at the end of cash flow of the month. And then you bring that balance up to the following month. So it's very easy like that, but the bigger your businesses are and the more you want to follow your trends, your cash flow will become more complicated. So this is a simple cash flow projection. As you see, we've got January, February, March, and April. The opening balance we talked about, that's how much cash is in your checking account today or your savings. If you're only using your checking account and you don't want to put your savings into this calculation, you don't have to. It's really for you. It's designed for you. The savings could be your cushion. So we're in your checking account. Your sales is $10,000, you're paying out materials, marketing, wages, so your cash flow is $1,000 for the month coming in. Coming in, so your closing balance would be $9,000. Then you jump to February, and again, you see everything happening month to month to month. Very simplified. If this works for you, that's fine. Finding, small businesses, this might be okay, but I'd like to see more detail, because if you see more detail, you can control more. So the how's of the cash flow. So how does the cash flow work? Okay, so we're gonna get a little bit detailed here. So there's 5 steps for calculating projected cash flow. The first one is, we talked about, you wanna find this is cash flow at the beginning of the period. So they give you a little thing, you subtract that, but quite honestly, if you have something in QuickBooks, you can easily see at the end of the month, my cash is X. Estimate income cash for the next period. So you need to predict how much cash your business will make during the next period. You also have to look at the incoming cash, including things like revenue, sales made on credit, loans, and more. So if you were getting a loan, that has to be calculated into cash flow. Some people take credit cards, so you've got to calculate that also. And then, of course, your revenue. If you have receivables, then you have to look at who's going to be paying you that month. You can forecast future cash by looking at trends from previous periods. So what you want to do is look at who your receivables are from, so who's going to be paying their bills to you, and you'll know which payers are slow. So if they're a 45-day payer, you wouldn't include them in this month, you would include them in the next month. So you know your customers, and that's what they're talking about, trends. Also, when you've got trends in the industry, let's say you're in a restaurant and there's a snowstorm, and everything's closed for 2 or 3 days, immediately you have to recalculate your cash flow because the business has been closed for 3 days, no cash, your bills are still gonna be happening. So again, there's a trend there, that type of thing. So some businesses depend on the weather, what the trends are, or maybe going back to school shopping, people come in the end of August. So your business, you typically know where your trends are. Estimate expenses for the next period. So you want to think about those expenses that you're going to be paying, when your utilities come due, rent is due at the end of the month, so it's there on time at the beginning of the month, or if you have a 10-day grace period, you can do that. But most of all, you want to look at the expenses for your materials. Those are the real important. Without materials and supplies, you're not going to function. Then you want to subtract the estimated expenses from your income. So you've got cash coming in, cash going out, and then add cash flow to the opening balance, which we talked about, and repeat, rinse, repeat, rinse. So it's not that difficult. I know when you first hear it, you freak out, you're like, oh, cash flow, I don't know what that is. It's pretty much just thinking through your business as to what's going to happen within a month. And then usually people project out 12 months best. Even if you did 6 months, that's good too, but I would recommend 12. So I wanted to show you this one. This one I think is a little bit more realistic as to how people do cash flows. So you've got Emma's cash flow. She's got her sales paid at 75% because she's thinking that she's probably not going to get 100%. She knows this because she has looked at trends, and she's got credit sales. Credit, loans, right now she doesn't have any loans coming in, and then she's got the cash going out, inventory, rent, wages, utilities, phone, insurance, ads, accounting, miscellaneous, all various taxes. I mean, everybody's different, but for the most part, this is what businesses look like. So then she's got cash at the end of the month is $3,340. We can go into more detail. I can actually read the example if you want to do that. I don't know how detailed you guys want. I can give you her story. All right, can't see my glasses on. So this is Emma's story. On January 2nd, as a New Year's resolution, Emma starts work on a cash flow projection for the next 12 months. She starts putting the $5,000 she has in her business bank account at the cash at start of the month, as you see. Account for January. In her cash coming in section, she includes her cash sales, which is about 75% of her sales, her credit sales, about 25% of her sales, on separate lines. She adds in all the cash sales, but only 80% of her credit sales, because some percentage of her credit customers always take longer than 30 days to pay, which is typical. In the cash going out section, Emma includes a variable and fixed costs. So variable costs are things that change over time. They're not consistent, like your utilities are usually like a couple $100, rents, fixed costs. Those are fixed costs that you're going to incur whether you're in business, making money or not. You're gonna have to pay them. Putting the annual insurance premium, she's about to pay in January column rather than spreading it over 12 months. Now you wouldn't want to spread that over 12 months because you've got to pay it in January. So you want to make sure you put everything in there, even though the expense covers the whole year. So it's easy to see why a cash flow analysis can give you a more realistic picture of whether your business will have money to pay its expenses. In other words, sufficient cash flow to stay afloat than a profit and loss forecast. So two different things. The P&L is not going to tell you when you're going to run short of money. It's going to show you after the fact. It's always historical. This is especially true for companies that make sale on credits, because typically credit sales are not paid within the expected 30 days. A profit and loss forecast does not account for late or missing payments, and that's why it's so important to do cash flow analysis as well. This part goes through December. So after filling in her cash flow projection, Emily realizes that her account will go significantly negative in the slow summer months. So you see August, she's having problems, September continues all the way through the end of the year. She will not even be back in black until December, her biggest sales month. Because she has estimated that about $500 per month in her payments on credit sales will be late, though if she eventually gets caught up on some of collecting her receivables, she will be profitable for the year. So again, cash flow, if you know you can get those accounts that are delinquent to pay up, this could eliminate your cash flow problem. So how aggressive are you? Do you think that these customers are going to pay? If you're aggressive, that affects the cash flow. Let's see, where am I? Okay, because she's already cut her own pay, that's not a good day, in half and trimmed other expenses to the bone, she'll have to bring in money from extra sales, provide extra services, get a loan from the family or friends, or bank line of credit. So the cash flow always makes you more proactive than reactive, which is why it's important to have one. Exactly what she said. She knows that she's gonna have a problem come August, so maybe you do some kind of promotion to have some sales, a good sale in August, clearance, get rid of some of the old inventory that's sitting there. You gotta be a little bit creative. And again, she cut her costs because she knew she was gonna have a problem. And that's always the action, but once it's gone by, it's too late, you can't do that. So the cash flow helps you again be more reactive. All right, so despite what your profit and loss forecasts say about your company being profitable or breaking even, over the next 6 to 12 months, if your cash flow projection is to go negative, means you are not going to be able to pay your bills when they become due, and you'll have to bring in more income or borrow some money to cover the shortfalls. So going back to the spreadsheet, Emmy sees that a loan of $8,000 would cover the shortfall, even accounting for making a small loan payment. So that's one. So as you see, on the loan and transfer, she's added $8,000. She's also hit the payment now, almost the third line from the bottom, $160 a month. So she includes that. Now, part of that obviously is going to be part of the interest as well as the principal, but it doesn't show here on the cash flow, which the cash flow doesn't need that detail. That's where the profit and loss would come in. My honest opinion, I'm not sure why she borrowed it in January. I might have waited until I needed it, but she put it in January. So going back to her spreadsheet, Amy sees a loan of $8,000 would cover the shortfall, even accounted after December. Let's go to the next one. Sales are all in. She still have a balance of $5,000.
So she didn't make her money back.
She didn't make any money. She took a loan, which means she's still going to have a problem on her financial statements, but for cash flow purposes, she's going to be okay.
But did she really make money anyway? Because she has 5,000 left over. She's paying on the loan, right? So the
No.
loan's going.
No,
She's not-
let's say she had to pay the loan back.
She can't.
Right, she can't.
Oh, she's not, you don't.
It's not income. She has an infusion of cash. So until her receivables, the ones that she hasn't collected, pay, she won't be making, well, it gets complicated, because you get your cash bases and you have your pool bases, so.
This is what not to do.
Right, right, depending on how you look
So
at it.
she's not paying on the loan for the month since she borrowed it?
No, she's paying on the loan, $160 a
Yeah.
month, but it's borrowed money. It's not paid out.
Yes, I know. Well, yes, but at the end, she has money left over, but
All
she
right,
has been paying it back
yes,
So-
correct.
all along. So
Right.
she
So-
still could have been close to break.
Not
Not
really,
really.
no, because you're only paying $160 for a
That's
year,
true.
so.
She never got paid that
Probably still has about 6,000 on it, so she's still gonna be short, even if she paid the loan back in December. But still, a lot of variables. If she collected more money from her clients or her receivables, she might be okay. Right?
It's a 0% interest. So
So
it's a
but-
PPP. So she doesn't have to pay it back. So it's a grant.
So Eddie also sees that if she gets a loan, it would let her business survive only about 12 to 18 months of lower sales before again she goes negative in cash the next summer. So in short, she needs to make sure that she can boost her sales back to the previous levels within the next 12 to 18 months, or she risks going back into the red again and will have to borrow more money. So she's not making any money. So that's when you have to rethink, what am I doing wrong? I gotta do something different. Or maybe this business just isn't viable and nobody wants to get to that point. But in reality, my theory is if you can't see yourself getting out of this hole and you're borrowing on your 401k or you're taking an equity loan to survive this business, you better think hard about it. Because one, if things still go south, you're not getting that money back into your retirement and you may have to lose your home. Not worth it. Get a job. And it's hard to do, but you gotta be a realistic person. Let's see. So Emmy sets about thinking how to come up with an extra $8,000. Her first thought is having a one-time sale, but even her usual 55% profit margin, she would need to sell an extra $14,500 in clothes to generate the much gross profit. After discounting prices for a big sale, she would lower her profit margin, meaning she'd have to sell more. If she sold her inventory at about 20% discount, her profit margin would be less than 45%, and she needs to bring in more than $18,000 in additional sales. So realizing that she doesn't have a realistic chance of selling that much inventory, she goes looking for a loan. When family, friends, and the bank turn it down, her last resort is to take out $8,000 home equity line of credit. This will allow her to dip into as needed to tide her over. In the meantime, she gets to work on a clever marketing plan to boost sales until better times are here. So now the next step, it's now time for the next step, which it focuses on your current cash position with an eye to improving it. If cash is flowing out of your business significantly faster than it's coming in, you need to examine 3 aspects of your cash flow: how and when cash comes into your business, how and when it goes out again, and where it gets tied up in the meantime. To fix your cash flow, you need more money coming into your business, increase sales, collect faster accounts receivable, less money going out of your business, reduce goods and labor, and less money tied up in your business. So don't keep a large inventory. Again, though, if you're in business and you're taking a draw, I mean, you want to be able to take money out of the business for yourself. And that doesn't include taking money out for herself. So she's working for nothing. Not a good feeling. Okay, so that pretty much does the cash flow. If anybody wants to talk about that a little bit more. Cash flows, honestly, you can go on Google and find a template, an Excel template, pretty much. I know QuickBooks, I think, has a new program that does cash flows. There's also many other programs that do cash flows. Cash flow, I don't know what it's called. I have one, it's rather expensive, but if you're in a big business, let me know and I'll find it. I think it's called Cash Flow. And it integrates with QuickBooks. And I love this because it pulls all the information out of QuickBooks and it projects automatically your rent. So it is some artificial intelligence and it'll grab things that they see constantly, like your payroll, and it'll bring that in automatically onto the cash flow. And then it also allows you to make changes. Like if you've got a customer that you know is going to pay 45 days, you can change those invoices. It's phenomenal because you can massage it as much as you want. You can export it into Excel. Not that I think you need to. You can change your starting cash, but the fact that it integrates with QuickBooks as well as it does it does a lot of the work for you. And then it has, of course, all these red things, if, you know, even when you're gonna go with red. So it helps you be able to be more proactive as to what you need to do to stay out of the red.
And what's that called?
The cash flow tool.
Okay,
I love it. I really do.
so it's like a tool within QuickBooks?
No, it's a separate program that integrates with QuickBooks, desktop or online, and I think they do other software programs. But I really, they started a few years ago, and I beta tested it, and they're still in it, and then they really put the money into it and made it a really good program. But again, there's cheaper ones out there, and the Excel program, if worse comes worse, is better than nothing. And it's easy to change Excel. They've got, like I said, the templates out there. I think the one that I have for the budget is, it's already written by Excel, the formulas for it, everything like that. So, any questions on cash flow?
Yes, I have a question. Do you see this, that was done by month, but do businesses, like, what type of business would you recommend doing that kind of on maybe like weekly
Weekly.
basis or something?
Yeah.
Because I think about, yeah, that's great, but like if a business
Right.
could run into issues in
Right.
mid-month.
Honestly, if you needed to go weekly, if you find that you don't have a lot of cushion, I think weekly is a good idea. Because then you can obviously react. If you're running a shoestring, weekly would be good, definitely. Especially if you see payroll coming up, and you know, come Friday, you're gonna be $5,000 short on payroll. That's a good, you know, the feeling that you have power to change that before it happens. And that's another reason for cash flow is, you know, you get the power and whatnot to control your business on that side of the business rather than having to fight with your husband, I don't payroll this week. Where are we gonna get the money? It's stress, it's very stressful on the family. So the cash flow will project that for you and then you can respond accordingly. Okay. Budgets, the whys. Oh, I think this is gonna put it, oh, it didn't. Oh, so it's a little bit of a strip. But anyway, why do we need a budget? There's 7 reasons why a budget is important to small business. I think there's more, but we've got 7 up here. It stops overspending, it helps you reach your goals, it helps you to save money, it helps you stop worrying and enjoy the money, allows you to be flexible, it puts you in control, and it can be simple, it doesn't have to be overly complicated. The what's, let me Google that, so, what is a business budget? A budget's a budget, I mean, I don't know, some people have it for their homes, it's the same thing, except you design it for your business. If you don't keep a budget, then it's pretty much sitting down with a piece of paper, writing down what you spend money on and what you've got money coming in. So a budget is a detailed plan that outlines where you'll spend your money monthly or annually. You give every dollar a job based on what you think is the best use of your business funds, and then you go back and compare your plan with the reality to see how you did. So you're gonna take a good guess, then you're gonna see what really happened, and then you're gonna find out how good you are at budgeting and where you need to be improving. It helps, budget will help you forecast what money you expect to earn. It will tell you what you plan, where to spend your money, and also you can see the difference in your plan and the reality. I definitely push people to do budgets. I don't see a lot of businesses doing budgets, quite honestly. But if you're a business, it will help you with, say, you know, you get to do a big advertising push. You can put that in your budget and it will help you from going over budget. That's the idea of the budget. So if you're gonna give your people $5,000 for advertising, they know they have $5,000. If they spend $6,000, well, guess what? Now you're gonna find another $1,000 somewhere else. And again, these tools help you to be, you know, proactive rather than reactive, because once you spend it, you can't get it back. Budgets, the how. So how do we budget? All right, how to start a budget. A business budget is an overview of your business finances. It outlines key information on both the current state of your finances, including income and expenses, and your long-term financial goals. So obviously, the budget, you want to perhaps open another store, or you want to add a line of a different product. So it includes that, but because your budget will play a key role in making sound financial decisions for your business, it should be one of the first tasks you tackle. And again, if you have good books, the budget is so much easier to do because you print a profit and loss from the prior year. You start from that. you know, this is what I spent last year. You're probably gonna spend the same thing this year on certain things, unless you changed your business, design as far as like changing, some sales items and whatnot, or things that you're gonna be doing. So you want to tally all your income sources first. You're gonna determine your fixed costs. Again, fixed costs are rent, utilities, things that you're gonna spend regardless of whether or not you're making money, you're not getting out of them. Include variable expenses, predict one-time spends, or maybe you have to budget in for a new machine, a new oven if you're in the bakery, and then of course you need to put it all together. You know, I hate this action. So I liked this one. I went, like I said, I went on Google and I Googled Excel templates for budgets. This is more or less what a budget looks like, and then plugging in the actual expenses and doing the comparison. QuickBooks does this automatically in the program. So you start with your annual budget for 2018 to 19, and these are your best guess based on your experience in the business, or if you're going to be doing something different in the business, you want to incorporate that. So you've got your revenue, your expenses, your net profit's going to be 22,000. So we have all of our revenue at 50,000. And then we've got our general and administrative expenses, salary, supplies, meals and entertainment, rent, and then of course the sales and marketing is separate, and then your research and development. But the key here is, what I like to see is you've got your actual expenses. So this was your best guess, this is what you actually spent. So then you've got your variance in dollars and your variance in percentages. So as you can see, the only thing that they really went over was in repairs, depreciation. Woo, big deal. So, I mean, depreciation too is one of those things that it's not really a money going out, it's a figure that the accountants put in. So, but we calculated in there because the budget is also projecting your profit and loss statement. It's a little bit different than the cash flow. That's why you need both of them. But you can see, these are over, I'm sorry. So this wages, they had budgeted 8,000, and then they actually spent 8,546. So they did do some overspending. Was it critical? Probably not. Doesn't look that, those numbers don't look too big. So some people I find like looking at percentages, some people like looking at the numbers. If I had a budget in QuickBooks and it's not broken down by month, which some people do, they don't want to break it down. You can see if you do a actual versus budget in June, you've got the total budget for the whole year. So when you're comparing, the percentage would be 50%. So you want to see everything at 50%, you're 6 months in, so you want to spend 50% of your budget. Unless, of course, it's insurance, and you pay that in full ahead of time, or it was a renewal of software that you had to pay in a lump sum. So you're going to see that at 100%. But for the most part, that's how I look at percentages. Another way to do a budget too is percentage by income. Some people know that like manufacturing, 70% is going to be on your cost of goods sold. So they can say, oh, I'm going to do, $1 million, and 70% of that's going to be expenses, and then the rest is budgeted. So again, it's getting familiar with your business, whatever works for you. But the key to all of this is what works for you. It's if you're doing something that you're not comfortable with, and you're not going to do it, then you need to find something that's going to work for you, whether it's weekly, monthly. Maybe you want to look at the utilities, split down in more detail, telephone, electric, city, gas. That's really up to you on how you develop your budget. But your budget typically matches your bookkeeping chart of accounts. Okay, anybody have any questions? Okay, so that's pretty much it in a nutshell. But again, you need to start sooner than later. You certainly could start in September, do 3 months, but I mean, we're almost at the end of the year. If it's not something you want to do now, make it a goal to do it January and watch the trends. I mean, the budget, if you do it budget versus actual, you can see the trends. Like I had one client that I look at the books, and we saw it's manufacturing that their cost of goods was all over the place, and it was the way we were keeping track of inventory. I mean, it should be consistent, like, you know, like I said, 53%, 57%, but because we saw there was these weird numbers, we knew something was wrong. Or, further down, you know that your, general expenses and administrative expenses, those are the things you spend to keep your office running, they're a certain percentage, and they don't really change that much, and if they do, you need to explain why it changed, what happened there, and have an answer for it. The other thing too is if you've got somebody doing your books, and you know what your trends are and your percentages, there'll be a blip if somebody's stealing from you. You'll see that. You can't trust someone doing your books to do them. You know, I mean, you want to trust people, but sometimes you just can't. And I've seen several times where the owners, after years of having somebody, they stole $200,000 from me. I mean, we're not talking little money because they trusted them and they were good people, but you don't know what their circumstances are. So you need to know your books regardless of who you have hired to do that. And the budgets and the cash flows will do that for you. So I highly recommend, if you haven't done it yet, get your books again on some kind of software package, get them organized, find something that works for you, keep it up to date. Don't wait till December to do your books because the taxes are going to be due next year, or don't wait to do it because you need to get a loan. They're a tool that you need to use in your business at least monthly so that you know you're succeeding in your business. A lot of people say, oh yeah, I'm making plenty of money, but you'd be surprised you're not making as much money as you think you are. And again, if you're not making money, then you need to develop a business plan and cash flow and budget so that you can make money, and these tools will help you to do that.
If people don't want to use QuickBooks, or are there other programs that you would recommend?
Yeah, I'm finding QuickBooks, if they're getting very expensive, especially QuickBooks Online. I mean, it's a commitment, it's $70 a month. Small businesses just starting can't afford that. I like Xero. Again, it doesn't always work for all businesses, but it's equally as good as QuickBooks. It's been around a long time. It's actually more popular, I think, in Australia than QuickBooks. I've heard FreshBooks works really well. I'm actually trying to do some training in Zoho. I don't know if you guys have seen Zoho commercials. It's more of a customer relation management, but they have like 40 apps that link into their program, and their accounting program has got good reviews. So I'm learning more about that, so I can streamline things, you know, bringing in my marketing as well as the accounting, and it's not piecemealed here and there. But it's a little bit complicated, but the FreshBooks I heard is good. There's a couple of other ones too out there that work well. But if you're going to do something outside of QuickBooks, I would recommend you find out if, in fact, you can import it into QuickBooks at some point in time. And if you're having somebody prepare your taxes, how do they want the information? Because a lot of accounts don't use Xero. They don't. I think FreshBooks is kind of popular. A lot of them are used to the QuickBooks, and they just take your file, but it doesn't mean you can't print it out for them. And there's lots of third-party programs out there now. It's overwhelming how many third-party programs are out there. So,
Great, thank you.
that's it.
Is Zoho a paid,
It is. I think the one that I have is Zoho One. It's probably expensive because I'm a partner. They give me one use for free, which is nice because I can learn it. But it depends on how many you want to connect to it.
okay.
This may be totally way too much more of an additional class, but what would you say are sort of the pros and cons of developing a budget like you put up there and more of like a formalized financial forecast? Like is it a particular business size or?
I think it is. I think a financial forecast is more for the larger businesses, than the small business. I just, I mean, what I like to see people do in their budgets, in a lot of the businesses, that you should have a capital improvement budget as well. So if you're in a construction business, you're gonna know you're going to replace vehicles or large equipment and backhoes eventually. So you should be having a line in your budget for capital improvements. You're not gonna see that in a financial statement, but you definitely got a budget for that stuff, because, you know, your oven goes in your bakery, you're talking at what, $11,000, $12,000, where are you gonna get that from? So, you should, you know, if you're not disciplined enough to keep it in your checking account, move it out, put it in a separate account where you don't touch it. Definitely. Yeah. I see it so often, you know, or they have to take a loan out, which isn't the worst though. there's a lot that goes into the planning. You know, you get to talk to your accountant because of, you know, people were finding that they, you know, making a profit at the end of the year, they have to spend the money or they pay taxes on it. Well, if you need a new vehicle, then go buy the vehicle, take the depreciation on your tax return. But then again, you have to, the accountant can predict whether or not you should take it over years or at the same time. And then, of course, there's scuttlebutt of changes in the tax laws. That you really gotta follow all of those things, which, you know, not everybody does. You just don't. But if you have a good accountant, they'll do that. You're welcome.
Thank you so much.
Oh, good.